Good morning, and welcome to this morning's presentation of the 2020 Institutional Investment Outlook featuring alumnus John Sticha. Before I share John's bio with you, I want to quickly thank our benefactors, Ron and Bonnie Swenson, for their generous gift that has helped us make the Swenson Financial Markets Lab a reality, and the asset has become to our students in the Herberger Business School. I'd also like to recognize alumnus Sherry Smith for her gift and help support the technology in the Swenson Financial Markets Lab. Thank you. John is a 2002 graduate of St. Cloud State University with a master's in bachelor's in finance and a minor in economics. He also completed his MBA in St. Cloud State in 2012. John is the Vice President of Investments at Western National Mutual Insurance Group, a super regional property and casualty insurer in Minnesota. John has over 17 years of investment experience across a broad spectrum of industry sectors. In his 13 years at Western National, John has overseen the general account as assets have grown from $350 million to over $1 billion today. Consistently outperforming the market benchmark. Prior to joining Western National, John worked at Bremer Asset Management. In his role, he researched, traded, and managed a variety of securities for clients, helping them achieve their financial goals. So with that said, I'd like to welcome John Sticha.
Well, thank you, Bill, and thank you, everyone, for being here. As Bill mentioned, I was a graduate at SCSU in 2002. Like a lot of people, when I got here, I wasn't quite sure what I was going to do. I was going to go for business, whatever that meant. I did not know at the time. I really liked history of rock and roll and a few of those classes, but I realized quickly that probably wasn't going to pay the bills. So it was, I believe, sophomore year, Finance 201, Professor Bonin. Some of you may have had him. That was a class where really things started to tick for me. I really knew at that point, I didn't know in what capacity, but I knew that this finance thing was something that I wanted to pursue further. I shortly thereafter joined the investment club, and in my junior year, I was also accepted into the Husky Growth Fund, which some of you may know is a student-run mutual fund investing in equities. While I was here, I did an internship at Northwestern Mutual, and I quickly learned that that was not an avenue in finance that I wanted to go down. Something about selling life insurance at 20 years old to people farther along in their careers that was just not a good fit for me. So at this point, I started to narrow a few things down, what I wanted to do, what I didn't want to do. Shortly after graduation, I was lucky enough to be hired at Bremer Asset Management, internship first, which I did for about 4 or 5 months. I was lucky enough to have an opening there internally, which I was hired for, and I transitioned into an analyst. I then began the process of kind of some junior portfolio management, accumulating a few accounts, some endowments and things like that I got to run money for. And this is when the light went off. This is what I want to do with my life. This was the avenue that made sense for me. The one thing I wanted to do, though, is I wanted to manage more money, less on the retail side and more on the institutional side. Through a connection, I learned about an opening at Western National. So in 2007, I made the move from Bremer to Western National, and I've been there ever since. As Bill mentioned, I started as an analyst. We were a 2-person team. We're still a 2-person team today. But as time went on, I accumulated more and more responsibilities. My boss was transitioning towards retirement, and I was able to then move into his role and was hired or promoted to VP of Investments. So a little bit about the investment department at a property and casualty insurance company. So we are a super regional insurance company. We have about $1.3 billion in investable assets. Our role is first and foremost to serve as the backstop for policyholders. When claims are filed, we have to be there to make sure the cash is available to pay those claims. I mean, that above anything else is our main purpose, right? We also are an important source of investment income for the company. When you think about an insurance company, essentially what it is to a degree, it's an arbitrage game, right? You pay your insurance premium, we get that money, we invest that money until we have to pay it out at a later date. So It's important that we invest those dollars wisely because we usually have a short window until we have to then pay out a claim. We'll also take part in rate setting. The more investment income you're generating, generally the more on the operating side you can offer more flexibility on your rates. When interest rates are very low, yields are low, investment income is harder to come by. You need to make more money on the operating side, and it's what's called a harder market. You need to price your product appropriately. So that's kind of how we work on the investment side, kind of how we overlap with the operating side of things, making sure that if we're not generating enough income, that they are able to price their product appropriately to offset that and so forth. Objectives of the portfolio. First and foremost, don't lose money. And while that sounds very intuitive, again, it's very important that we remember what we are. We're not a hedge fund. We are not a high growth tech fund. We are a fairly conservative and boring general account managers, right? We don't take a ton of risk. We have to be there for our policy holders. Again, I mentioned generating investment income. We generate about 60% on average of our net income after tax on an annual basis, sometimes a little higher, sometimes a little lower, but certainly 60% is a significant chunk of income for our company. We'll talk a little bit more about total return and then again, liquidity. We know that we need to be there for our policyholders. We know as a company that writes a lot of in the Midwest, we know when storm season comes. We know when it's tornadoes. You look at what happened in Iowa a couple weeks ago at the derecho winds. We knew that was going to be a bad event for us. We write a lot of policies in Iowa. So it's very important that we're working with our accounting group to make sure that we're there and we are that backstop with the liquidity to meet our needs, especially during storm season, those 4 or 5 months of the year. As Bill mentioned, I started in 2007. You can see on the graph we were about $400 million then. We are about $1.3 billion now. I would like to tell you that's all because of me. It's not a coincidence. That snapshot is over the time I've been there, but of course that's not entirely true. A few of the reasons for that growth. Certainly, we've had acquisitions along the way, and when you acquire a company, you're acquiring their assets, including their investment portfolio, so your assets grow when you bring them on board. Interest on interest growth. We invest a lot in bonds. Bonds pay a coupon. We get that coupon. We invest in other bonds and so forth. We have a very cheap line of funding at what's a government agency called the Federal Home Loan Bank. They give us money at rates, at very, very attractive rates. We're able to invest that at a higher yield, and so we are not shy about using that facility to help improve our overall investment income. And then, of course, the decline in interest rates. And for people that don't know, yields on bonds and market value and prices have an inverse relationship. So if you probably understand, interest rates are very low right now, and when that happens, the market value of your bonds are higher. And we'll talk a little bit more about this later on, but that's caused certainly a significant amount of appreciation in our portfolio, driving that asset under management growth as well. So what do we hold within the portfolio? Like a lot of P&C insurance companies, fixed income or bonds are our bread and butter. We are about 87% fixed income. Along the lines of those objectives, we are a high-quality portfolio. Again, back to that preserving of principal. We have a AA- average rating, which for those that don't know, that is the 4th highest rating by the rating agencies that you can have. Again, high level of liquidity. We invest a lot in what's called municipal bonds, and we'll get to that as well to maximize our after-tax yield. And again, along the total return lines, we have a very diversified portfolio. We balance our sector and our issuer weightings as well. We have 6% of our portfolios in equities, and we take a very passive approach in equities. Essentially, you can break down our equity portfolio into 3 buckets. We have an international manager in a mutual fund. We have a mid-cap growth manager with buying individual securities that I've known for years, and then we buy the S&P 500. Very much capture the market return is our objective within equities. Try to add alpha elsewhere through our fixed income outperformance, through our alternative allocation as well. Which brings me to our next bucket. We have about 7% of our portfolio seeking higher returns via private equity, via hedge funds. And so the combination of the 3 are really the 3 buckets of our portfolio. Since fixed income is 87% of the portfolio, we can talk a little more in depth about what we own. Our largest asset allocation, or our largest sector allocation, is municipal bonds. So think of this as any city, any county, any state, any baseball park, any toll road. Any of these issuers can come to market, and when they seek money, they will come to what's called the municipal bond market. When the town you live in passes a referendum for a school, it's $100 million. That money doesn't fall from the sky. Instead, they essentially have gotten the okay to come to investors like myself, issue $100 million in bonds, and then as you see your property tax go up, you're essentially servicing that debt. So a lot of different issuers in the municipal bond space. It's a big allocation for us. Secondly, mortgage-backed securities. When a bank issues a mortgage, let's say Wells Fargo issues a mortgage, they have two choices essentially. They can hang on to that mortgage and keep it on their balance sheet, which is fine. It's profitable for them hopefully, but then they run that risk of being able to not have, it basically ties up capital for the bank. So the other option for a bank would be to take your mortgage, take other similar mortgages, bundle them together, and sell them to investors such as ourselves. Third largest allocation, corporate bonds. Pick your favorite company, whether it's Target, whether it's Apple, whether it's Disney, they all come to the corporate bond market, issue debt periodically from various maturities from 2 years out to 30 or 40 years in length. And then the last piece is asset-backed securities. This can be your auto loan receivable, this can be your student loan receivable, all these things are securitized. And I think what I'd like to tell people is when you think about all these things, it really highlights how important a good functioning financial markets are, because so much of your life, whether it's your student loans, whether it's the house you live in, the shoes you buy or the school you went to, there's a good chance that they were financed, through Wall Street and hence by investors, institutional investors such as ourselves. So again, that's our fixed income allocation and a little bit about each one and who the issuers are. Just some real quick basics on bonds. When we buy a bond, we have a yield. Essentially, your yield is your total return for the life of that bond held from start to finish to the day it matures, which, again, most bonds have a maturity date. That time, you're expected to get your principal value back. Tax status, whether a bond is tax exempt or taxable, is something to think about. If you are in a higher tax bracket, tax exempt may be very important to you. If you're lower, you may not need to see the value in tax exempt investing. Every bond essentially has a rating. There are three major, call it 2 or 3 minor rating agencies, one of which generally puts what they perceive the risk to be on that bond on as a rating. And then the other basic, like I said, the price to yield relationship, basically an inverse relationship. If interest rates drop, market values and bonds go up and vice versa. This is just a snapshot I thought I'd show. This is something we share with our board of directors quarterly, our senior managers on a monthly basis. Just, again, kind of a snapshot of what we hold. You can see in the upper left our asset allocation by fixed income, by common stock. You'll see some metrics in the middle, such as how much duration or interest rate risk our portfolio takes. You'll see what our average credit rating is. In the bottom right, you'll see that asset allocation I was talking about. So just kind of a one-page bring it all home to share with management and our board members on a regular basis. So day-to-day portfolio management, what do I do? So despite popular opinions, I do not play fantasy football all day long. I do not gamble on sports all day long. No, I do things, and here it is. So certainly buying and selling bonds is a big portion of what we do. Each and every month, we get money from our operations that needs to be invested. We have principal and interest from the bonds we own that needs to be reinvested. Between the combination of the two, it can be anywhere from $12 to $15 million. We spend a whole lot of our time looking at kind of swap ideas. Should we sell anything? Should we buy something else? A ton of time reading research, trying to find value, trying to find ideas, where we should invest our money. That's basically makes up 75% of my day. As you can see, we invest on average about $350 million a year. The other 25%, less glamorous. That's the paperwork, dealing with getting reports ready for investment committee meetings, dealing with different states where we have to file certain bond holdings. Less glamorous, but part of the job. I put about 25% of my day on those. Risks and considerations. So as largely fixed income investors, we kind of have 3 pillars that we really have to think about when making investment decisions. First and foremost is credit risk, right? Credit risk, you have to think about what are the odds of your bond not paying, defaulting, and then you not getting your money back, right? One way we manage that risk is we have a limit of 1% per issuer, so I can't have more than 1% of the portfolio in Apple. It's just an investment policy guideline as a way to kind of diversify our risks, make sure we're not too exposed. I think in 2008, people learned the hard way of having too much exposure to one sector, to one particular issuer, and so we have these guidance in place to make sure we do not. Secondly, interest rate risk or duration, how sensitive your bonds are to changes in interest rates. If interest rates are going to increase significantly, your bond in value is going to go down significantly. So we have to think about what our view is on interest rates and take that into account, because when you buy a bond, you're buying a fixed payment of interest, right? And if interest rates increase a lot, perhaps due to inflation, your payments are worth less. So that's something we always have to consider. And then lastly, concentration risk, not just with our issuer, but within our sector. Again, back to 2008, if you had a lot of exposure in the banking and finance sector, things didn't work out well for you. A couple years ago, if you had a lot of exposure in energy, when energy traded down to $15 a barrel, that probably didn't work out very well for you. So it's very important that you have these policy checks in place to make sure that not only from an issuer, but from a sector level, you're diversifying and you're not exposing yourself to too much sector risk. So security selection, again, despite rumors, we do not throw darts at boards. We do not have a magic 8-ball. We do not call Miss Cleo. There are a number of ways we come up with investment ideas. Those are not any of them. A lot of them come internally. We have what's called a Bloomberg system. I know SCSU has one now as well. We get a lot of ideas from that. We make a lot of charts. We compare this sector to that sector, look at it historically, try to make decisions of, is this cheap now? Is this expensive now? We get a lot of ideas through sell-side research. We have, I'd say, 15 or 16 trading relationships out there. Most of those provide research to us on either a daily or weekly basis, and we'll show a report or two here coming up. We have analytics on our portfolio, similar to what I showed earlier. We know what our credit risk, our sector exposures are, our interest rate risks, and that helps drive decisions as well. All right, so just a few screenshots. I'll kind of get through these quickly. Back to the Bloomberg side of things, this is just a snapshot of one of the many pages we use on Bloomberg, but this is kind of like the home page for us. This has everything you ever need in one screenshot, whether you're trading currencies, energy, interest rates, equities, it's all on one home screen. So I just wanted to kind of put that on here as an example. Here's a description. So a bond we might be looking at, a Nike. This is a Nike issue. You can see in the middle of the page, comes due 2045, issued with a 3 7/8 coupon. On the mid-right, you can see a bond rating, rated by Moody's, S&P, and Egan-Jones. And below that, you can see the issuance size. It's a $1 billion issue that they came to market with at the time. So through Bloomberg, I mean, it's the amount of news and the amount of data we get is more than we could ever take in, but it's such a useful tool. This is a snapshot of what a yield analysis looks like. These bonds would be offered to us at this price and at this yield, and it's up to us to decide, is that historically, does that make sense? Are these attractive? Are there better options with our money? Bloomberg, again, one-stop shop, whether I want to look at an income statement, balance sheet, statement of cash flows, I have it all right there with a couple pushes of the button. That's why it's a big part of help driving what we do when we invest money. We like to see more transparency, the better. It helps us see where previous bonds have traded and are we being shown a fair offer. Just a few on relative value analysis. This is looking at different states issue municipal bonds for municipal investors like ourselves, just looking at what states are trading cheap historically, more expensive historically, kind of on average. Here's just kind of a cross-sector relative value analysis. As you can see, one of these blew up very wide a few years ago. That's something that may trigger us to say, hey, this is too extreme, uncalled for, this is good value. Again, just another way we may find value to invest in. Bloomberg is excellent for the messaging system. All our brokers and all their traders and everybody that they know likes to send messages. They do it through Bloomberg. We see pages and pages, hundreds of these from every day. Offers on there, some just to talk. Again, here's a glimpse at the sell-side research. Now, you might be able to see that this is over 130 pages. This is something we get weekly. I promise you I do not read these start to finish every week. I do not have that much free time. But it gives you a nice kind of summary page on page 1. If there's something you're looking at, something that interests you, a sector you might be considering, this is what's in that report. And this also drives a lot of our research, or a lot of our investment ideas. Analytics that we get from our trading partners or our brokers, just again kind of giving a summary of the portfolio, where our sector allocation is, where our interest rate risk is, and so forth. Each kind of have their own variation of this, but this is kind of a good one-page summary that we got from, in this case, Piper Jaffray. So how does Western National compare to our peers? How are we similar? How are we different? So first and foremost, credit rating-wise, we tend to be a little bit higher quality. As you can see, as I mentioned before, we have a AA- rating. Our peers are A+, which is just one step lower, and that's the rating not of the company themselves, but of the average of the bonds that they buy. Our book yield is higher than our peers, but we also take on more interest rate risk than our peers. And really, the reason for that is the fact that we tend to operate profitably as an underwriter. We make money almost every year underwriting, so we are able to kind of take more of a total return approach to our investing, and I'll touch on that a little more in a bit. We do not carry as much equities as a lot of our peers. You can see the industry average is around 20%, but for the most part, we have more in our alternative assets. So we look at the alternatives and equities as kind of our, if you would, our risk bucket. So it's about 13% between the two. Most of our peers do not have the same alternative exposure that we do. They have higher equity exposure, however, but by sector comparison, so the biggest thing to note here, how we differ from our peers, is those first two lines. You'll see the corporate and tax-exempt munis. And really that gets back to what I just said. When you make more money underwriting and you're profitable every year, you get more benefit from the tax exemption of municipal issuers, city, counties, whoever. So that's why you'll see that 37% for us, about 20% for our peers. But that comes, top bucket corporates would just be the opposite. So they buy less tax exempt but more corporate bonds because they may not have the same use for that tax advantage that we do. So what do I think we're good at? What makes us good at as investors is, I think it's, for one, our size. Some of our bigger peers, you can think of some of the names, they're forced to buy very big bond allocations, $5 million, $10 million, $20 million a clip. Right, because they have portfolios that are 2, 3, 5 times bigger than ours. And that's great, but it's much harder to get an allocation when an issue comes to market, when you have to buy such size. If we operate in this, our average bond holding is about $3 million of each position. In that 2 to 3 million, that's kind of a sweet spot where I think you can get better execution than some of our peers, so I think that certainly helps. We also rarely make big allocation changes, moving 5, 10% from one sector to another. It's just not what we do. And I think when you don't make those changes, you can be more selective on what you buy. If you have to move 10% from sector A to sector B and you need to do it in the next couple weeks, at a certain point, some of our peers kind of have to take what they get because they have to get that money invested in quickly. So I think that's certainly an advantage. And then flexibility. Really, for a two-man team, we have an investment policy that, again, limits sector allocations and issuer constraints, but within that, we are allowed to really move around where we see value. If a sector changes over the course of a week, we can get out of it, we can move around, go somewhere else. So I think those kind of are the three that have helped us over time. Just quickly on benchmarking, what it means, it's a means to measure success. You can be a total return investor or you can be an income investor. Now, a lot of people are familiar with, say, the S&P 500. A lot of investors try to beat that. That would be a total return benchmark. There's also, some investors in the P&C universe benchmark to a comparable indice, but others are more income focused. And it's kind of a never-ending story of, what should we care about more as investors? Most of our peers, like I said, are one of three ways. They'll set a yield target, and they'll only buy bonds that yield above that target. They need X amount of income, and that's really how their decisions are driven. Some of our peers are very much asset liability matching driven, so they may be very reliant on their investment portfolio, and they need to know that that their assets do not move far from where their liabilities are. For example, if you write a lot of auto insurance, you're going to have a very, very short liability. That means you're going to invest for a very, very short time frame as well. And where do we land? Generally speaking, we're kind of a hybrid model. I would say that we are total return with an eye on our income. We don't make any changes that will, meaningfully impact our income in any year necessarily. So we're very cognizant of it, but yet total return tends to be our driving force. I'm going to come back to this one if I could real quick. So how have we done? Now, these portfolio returns are through 9/30, and as I was talking to Bill before, certainly the COVID-related issues in March impacted our portfolio significantly. We take a fair amount of credit risk, and you can see top line in bold is our total return that's our total portfolio, equities and fixed income. The second bolded line, our fixed income return, is just our bond portfolio. 1 year numbers trailing the benchmark a little bit. 3 and 5 certainly look better. I put this in here, this next slide in here is a reminder of the better times, how things looked pre-COVID. As you can see, total return, the fixed income return, you pick it, all look good. So the 3 or 4 weeks in March when people were really panicking absolutely hurt the portfolio. We've been clawing our way back ever since, and we're getting close to the bogey for our benchmark for the year, but still have some work to do. But this is a much nicer return chart. I almost just put this one in, but I thought I better tell the whole story. Just jumping back here, so what's going on today? I listed these 5 things. I mean, this is just through August, and it's pretty amazing to me that this all happened in one calendar year. I mean, we have seen the end of the longest equity bull market in history, fastest decline of 30% in history from February 20th to March 23rd, largest 5-month gain in the S&P 500 since 1938, lowest unemployment since 1953, and the highest unemployment since the Great Depression. 8 months in 2020. I mean, that's what we're dealing with this year. And so when people say it's been a wild year, yeah, I think that these stats kind of speak for themselves. So we are asked frequently, with so much going on, and they're still in the middle of a pandemic, unemployment is still high, how can markets be at or near all-time high? I mean, what's going on here? So just, chart on the left is unemployment rate in the U.S. So you can see, the lower bump is back in the great financial crisis, 2008, 2009, and you can see how, earlier this year just simply blew that percentage out of the water as we were at double-digit unemployment. I think we peaked at, 13%? I was over 14 actually. Chart on the right is the GDP, or the gross domestic product output in this country. Steady as she goes for the longest time, absolutely falls off the cliff in Q1 and Q2 of this year. So again, back to the question, how can markets continue to do as well as they have? Well, there is not a perfect answer for that. Anybody trying to tell you there is probably selling you something, but there have been a few things that have helped. Certainly fiscal policy. Earlier this year, when this pandemic hit, we had the $1,200 checks that went out to people. We saw boosted unemployment benefits for people. The difference in this chart, the blue line, is where incomes of consumers would have been without any of that fiscal policy. Black being where they were as a result of. So certainly people, from a short-term perspective, people actually had more money. Again, not an ideal situation in the middle of a pandemic, but because of the enhanced benefits and the checks that went out, consumers were it certainly lessened the burden on people, and I think that helped. Certainly monetary policy has helped. The Federal Reserve has expanded their balance sheet now to over $5 trillion, actually $6 trillion. They buy up bonds in the market, and the whole idea of that is to try to push interest rates down to help the consumer, to, let's be honest, encourage risk-taking. If anybody's looked at where mortgage rates are lately, you see it in your day-to-day life. I mean, we have 30-year mortgages now that are, sub 3% at this point. So the Federal Reserve is taking bonds out of supply, pushing interest rates down. Again, good when you want a mortgage, your auto loan, what have you. Good for company XYZ when they want to issue debt because they can do it cheaper than they ever have before. And all of this does have some stimulating effect. That and the last bullet I said on there, that and the lack of really other good investable ideas have helped. I mean, when you think about globally, in the developed world, over half the debt issued out there, especially in Europe, is at negative yields, right? Actually not paying investors a positive rate of return. So when you look at what's going on in the U.S., I would say that our markets certainly look like the least dirty shirt when compared to a lot of others out there. So again, there isn't one single factor that's helped. You were almost at 29,000 again on the Dow, but all of these have played a role. All of these have helped. And so what are we doing internally? It is our strategic view to take on more credit risk than our benchmark. While there will be bumps in the road like there were in March of this year, over the long term, we think that approach will pay off. Keeping a longer duration. As I talked about, the Federal Reserve has said we are keeping rates low. We are not even thinking about raising rates. So with that mindset, we think that we could take a little bit more interest rate risk in our portfolio. Just a couple sectors we find value in. Our equities are going to stay very passive. I don't see that changing. We generally just add to the portfolio when it feels opportunistic. We did a little bit of that back in March and April. We just kind of wait for those bumps where we think things are mispriced and there's an overreaction. That's when we generally add. And on the alternative side, it's again trying to be opportunistic. It's investing in spots that we can't do it ourselves because maybe it's not investment grade or maybe it's a sector that we don't participate in. But trying to be very opportunistic, like we were investing in real estate securities earlier this year, for example, because we think over the long term, if we can just selectively pick our spots instead of continually add capital, that we can do very well there. So along the lines of being a shameless self-promoter, if you want to connect and talk more, I've got my information up here on the Twitter, as well as email, phone. And with that, that's what I've got for a presentation. And I think we're going to open it up and do some questions, if I understand correctly.
Yeah, thank you very much, John. So we have a couple students from the Husky Growth Fund here today. Megan Kelly, who is the current president of the Husky Growth Fund, that class that you were in.
Sure.
And then we have Kevin Fitzgerald, an accounting major actually, who was in the Husky Growth Fund. They've kindly agreed to share their time with us and ask some questions. And as we go along, if you don't mind, I'll ask some follow-up questions as well that kind of came to mind for me.
Sounds good.
So who wants to go first?
Thanks, Dr. Hudson. I just had a question. How reliant are you on what rating agencies say about a particular investment you're looking to make?
Sure. So rating agencies took a lot of heat in 2008 and 2009 for their actions, especially in the mortgage-backed space. I would say we're not reliant. We use them for guidance. I think anytime that they are rating a bond that has little subjectivity to it, say a corporation, I think they're pretty good at that. When you start to get into more esoteric securities where subjectivity comes into play, I think they have struggles. I don't think they're perfect by any means. Their model takes some heat. I understand that if you come to market, you pay a rating agency to give you a rating. So there is a fine line there that they need to walk to give you a rating, but at the same time, they're for profit. They want to get paid. So I would say the answer is we look at it. We know what it is. We're cognizant of where they're at. We do our own credit research to make sure what they're telling us is correct, because they certainly have their flaws. Their model, for one, some of the subjectivity in more esoteric securities. So long answer short, use it, don't rely on it 100%. Guidance.
I guess that was part of a follow-up question.
Yeah.
You mentioned you do your own research.
Yeah.
Do you actually go out and contact these companies directly?
No, so muni bonds, for example, when they come to market, they will issue like a 200-page official statement. So we can go in there, we can get all their, see where their financials have been, see the demographics of the area, learn all that information. So we will not necessarily go out to the issuer, but we'll go into reports like that. So we get each and every new issue that comes out, we can see stats like that.
Okay,
so,
sure.
Yeah, so.
So in your opinion, how can an upcoming graduate stand out to potential employers?
Good question. For me, it wasn't GPA alone, that's for sure. But Pause for laughter. No. I think it's really. I tell people spend a lot of your time getting out with professionals and meeting with them. Short story here, but I was as a grad student, we did a study abroad trip in Brazil, and half the students were undergrads, half were grad students. And I got to tell you, I was kind of disappointed that the undergrads at that time did not utilize the fact that there were 14 graduate students with them at all. And several of them, for me, were finance majors. And the only time we talked about, the first thing I heard out of their mouths was, what's it pay? And I'm thinking about like when I started as an intern at Bremer. I mean, I was making $10 an hour, right? I mean, I made more selling suits at Penny's in college, to be honest. But the point is, don't worry about that. I mean, go get a job where you can see a path in your future. And that's why I took that internship, because I saw where it could be. I saw what the other people that worked there were doing, and I knew I wanted that. I'll suffer along with the intern pay for a while, but really so 2 points, interact, get out, talk to business professionals. It means a lot. I think it goes a long ways for you. And then don't be afraid to take a job that maybe isn't glamorous out of the chute if you can see a path for something you want to do. Those are, my 2 bits of advice in that regards.
And then you talked about tax status. How big of a role does tax implication play in investing in municipal bonds rather than corporate bonds?
Yeah, that's a great question. So several times a week, we will compare where our after-tax yield will be on exempts to a corporate bond. Right now, post 2017 tax code change, exempts less attractive. One thing we are thinking about here with an election coming up is what they could look like more in the future. So our exempt holdings actually used to be a lot higher, closer to 55, 56%, and then we dipped in the low 40s post tax change. Not that we're making any election. We do not like to make big, broad, bold statements or predictions. It's not what we do. We just like to, focus on individual and sectors and securities. But we are thinking about that going forward, what this November election could look like. I assure you that corporate tax rates will not be any lower going forward. I feel pretty confident saying that. Could they be higher? Yep. So it's now, since we run all the time, to answer your question, and we are thinking about, should we be buying more exempt bonds today? Maybe they don't look as good today. Maybe they look okay. It's kind of what I call a heads I don't lose, a tails I win if tax rates go higher in the future. So that is one area we're starting to actually invest more. Not back to where we were 2016 and beyond, but certainly adding exposure.
Just a follow-up question, have you seen with the new tax rules, have you seen the yields on the tax exempts actually increase? Their cost of borrowing has gone up?
No. Cost of borrowing has still been very cheap. It did not matter because what happened is, especially coastal states had the SALT tax, you can only deduct, was it $12,000? And so in coastal states that were very reliant on higher levels of deductibility, they were big buyers still of tax exempt bonds. So the tax code did not change. And the reality is that individuals are actually the bigger buyer of exempts than institutions.
Okay.
And so as an individual, even if your tax rate came down, which it did not to the same degree corporate tax did, right? If you're still 25% tax rate or even in the low 20s, they're attractive to you at this point. So no, actually they were yields, they moved in unison with everything else, and rates were lower and spreads were actually quite tight in the exempt space for a while.
Do you forecast any change in your investment strategy in the near future due to COVID-19 or other potential factors?
Yeah, so in addition to the upcoming election, the other thing we're thinking about, and I was talking to Bill a little bit before, is really the impact on commercial real estate, right? How many people are going to go back to work every day? There's been a lot of talk. Some people are, sounding the alarms. We're never going back to work. Everybody's going to work from home forever. There's other people that say, no, this is a temporary blip. I think there'll be some impact. I was just telling him I saw a study today that, one firm is predicting that rent prices may decline by 20 to 25% going forward, and 4 or 5% of the workforce may never come back. I think that there is an appetite, though, for people to wanting to get back to work for the most part. Some love working from home every day. It's not me, but I think there is an appetite for people to get back. But the point is we're thinking about this because we own a lot of commercial real estate via commercial mortgage securities, not directly, but through securitization. And office properties are a big chunk of that. So we are thinking about kind of what that workforce will look like in the future and kind of the best and worst case scenarios for people going back to work and what kind of timing that might be as well.
So I have it's not really a follow-up question.
Sure.
I was waiting for a appropriate question for this, but I didn't see it, so I'm just going to go ahead and ask it.
All right.
In terms of paying claims, you have your average duration is about, what, 5.3 years?
Yep.
Where do you keep the liquidity on your balance sheet to pay claims? Because you want to be able to sell things quickly without a price hit.
Selling is actually the least desirable option for us, right? So we try to make sure we have, so it's kind of a trickle effect. We have our operating account, just basically our checking account, right? That we keep enough to, so the reality is if a storm came through the area, you do not pay claims overnight. We know that, so you have a few days if you need to generate cash. This last go around with the Iowa winds, we had enough cash in our operating account. We actually were never tapped for that because the reality is when you look at our book yield, if we were to sell something out of our portfolio, that's the kind of income we're giving up. That's how you want to think about. So that's your cost to pay those claims, right? So we want to try to not, if possible, tap that, right? So it's operating account. We also have a very cheap line at the Federal Home Loan Bank, a government agency that, as long as you as a member are doing enough to promote housing, which we are through our securitization purchases, you can get advances there at rates that will blow your mind. So we like to look at that as a second option. And then third would be, of course, to sell securities. But again, it's less ideal if we can help it. So that's kind of the progression of things. But we were very much, a couple weeks ago, we were very much on hold, letting cash accumulate because we were not sure if we were going to need to, send cash the other way. On average, we get about $40 million annually from operations. So that's net money coming to us versus going out. But yeah, that's generally the waterfall of things. It's go to operating first. It's considered taking a short-term advance at 30 basis points or whatever. It's dirt cheap, right? So beats selling a bond at 3.5% or 4%, right? So and then look at security liquidation.
We got one more question left that came in. People have heard that Allstate is now offering insurance on identity theft and data security. Is this an attractive new revenue opportunity for the industry?
So I'm not going to claim to be an insurance guy. I just usually know enough to be dangerous. But I think that will be. I think identity theft is certainly, I don't want to say the wave of the future, but it's certainly something that I know that the powers that be have talked about it internally. So I know it's not lost on them that's very important. But we just kind of internally went through a cyber security issue and I know that we have a cyber policy in place as a company, and I know that is going to have a lot of importance going forward too. So I think it is. A niche product like that is going to have some value. I mean, we've seen any niche with profitability finds a market. I mean, we've seen it with pet insurance 10 years ago. That all of a sudden came out of nowhere, and now that's generally very profitable. And so there's always some new avenue for revenue, and that will certainly, I think, be one of them going forward.
Any other questions? Good. Well, I want to thank you for your time and coming back to your alma mater and your hometown.
That's right.
And so we have very much enjoyed having you here. And once again, thank you for your time.
Thank you. Thank you for having me. Appreciate it.